All right, welcome to this explainer. If you've been paying close attention to your paycheck lately, you might have noticed things look, well, a little different. And that's because as of July 1st, 2026, this massive wave of tax and financial changes just kicked into gear across Australia. We are talking major structural shifts here to your income tax rates, how your superannuation works, the way they calculate your student debt, and even some entirely new deductions. So our goal today is to cut right through all the boring jargon and show you exactly how this affects your wallet, step by step. Okay, let's dive straight into this. Take a look at this quote, because it perfectly captures the stakes we're dealing with. It says, "The difference between winning and losing here comes down to whether you actually know what changed." And honestly, they hit the nail on the head. Some of these changes are literally going to put money directly back into your pocket, while others, well, they could end up shaking more out if you aren't prepared. So the people who adapt and use these new rules are going to win, plain and simple, while those who ignore this explainer and just stick to their old habits are definitely going to fall behind. So here's our game plan for today. We're covering the typical financial journey, starting with number 1, more money in your pocket. Then 2, fixing your student debt. 3, the new superannuation rules. 4, housing, health, and investments. And wrapping up with number 5, small business tax boosts. Starting off with section 1, more money in your pocket, focusing on income tax and daily earnings. All right, so we are now officially entering the 4th round of the legislated tax cuts. From July 1st, 2026, the tax rate on income between $18,201 and $45,000 has dropped from 16% to 15%. Now, to give you a real-life example of what this actually means, let's look at an average worker bringing in around $81,000. Now, sure, while the initial drop this year might just look like a couple $100, this bracket is already scheduled to drop again to 14% by 2027. So when you stack all these rounds of tax cuts together, our $81,000 earner is looking at nearly $2,500 in annual tax relief by next year. That's a serious chunk of change. And this brilliantly illustrates our next point, a brand new $1,000 instant tax deduction for work-related expenses. Yep, you heard that right, it's an automatic deduction, and it's delivering an average immediate saving of around $205 to over 6 million workers right now. Now, think about the old way of doing things. It required you to keep a literal shoebox full of fading receipts for every single pen and notebook you bought. It was a nightmare. But the new, simple way? You literally just tick a box when you lodge your tax return and boom, your taxable income drops by $1,000. 0 receipts required. Now, a really crucial caveat here. This doesn't replace the old system. If your actual expenses are, higher than $1,000, you can absolutely still claim the real amount using your actual receipts. You can also still claim things like union fees, income protection insurance, and investment expenses on top of this automatic $1,000 deduction. Before we move on from daily earnings, we absolutely have to highlight the minimum wage increase, which is impacting roughly 2.8 million Australians. Minimum and award wages have jumped by 4.75%. That brings the national minimum wage up to $26.44 an hour, which finally crosses that psychological barrier of $1,000 to sit at $1,004.90 per week. And for those on entry-level rates, the bump is even higher, coming in at nearly 6%. To put that into perspective, this is the largest dollar value increase to the minimum wage in recent memory. Moving right along to section 2, fixing your student debt, looking at the fairer HECS and HELP repayments. Okay, so the old HECS system was essentially this punishing flat rate cliff. If you crossed an income threshold by even $1 single, your entire repayment obligation could jump by thousands. It was crazy and a massive disincentive to actually try and earn more money. But look at the new system, fairer marginal rate scaling. It now works exactly like your normal income tax. For the 2026-27 financial year, the threshold is $69,528. If you run above that, you only pay 15 cents on the dollar for the income above that line, scaling up nice and slowly through higher brackets. And wow, let's definitely not forget this massive number. Back in June of 2025, the government passed a 20% flat reduction to all existing student loan balances. The ATO has already processed this, but amazingly, millions of people out there still don't even realize it actually happened. So, here's a real-life example to show you the tangible impact of that structural wipeout. Say you had a $30,000 HECS debt. Well, that 20% cut means it was automatically reduced to just $24,000. You literally didn't have to lift a finger, but it just shaved years off your repayment timeline. All right, let's get into section 3, the new superannuation rules, or how you're growing your retirement faster. Now, what's really interesting about this slide is how it fixes a massive loophole in the Australian retirement system. Under the old rules, your employer could legally just sit on your super for up to 3 months before actually paying it. Billions of dollars were going unpaid every single year. But now, under the new payday super rule, your super has to reach your fund within 7 business days of your payday. So if you get paid fortnightly, your super lands fortnightly. The result? Your money starts compounding much, much sooner, which, if you stretch that over a 40-year career, adds up to a staggering, truly meaningful difference in your final retirement balance.
And for those of you actively trying to boost your retirement, great news! The limits have just been raised. Looking at the table, the concessional cap, so that's your salary sacrificing and your employer contributions, has gone up from $30,000 to $32,500. And the non-concessional cap, for those after-tax lump sums, has jumped by $10,000 up to $130,000. This simply gives you a whole lot more headroom to build your wealth in a highly tax-effective way.
Next up is Section 4, Housing, Health, and Investments, covering the structural economic shifts.
Let's see how these shifts impact your everyday health decisions. As you probably know, if you don't have private hospital cover and you earn over a certain amount, you get hit with the Medicare levy surcharge, which is an extra 1 to 1.5% tax. But from July 2026, the goalposts have moved. The new threshold for singles is now $105,000, and for families, it's $210,000. So if you were earning just above the old limit, you might now fall safely under this new threshold. And dodging that surcharge can literally save you over $1,000 a year, which makes this a super vital piece of math if you're currently on the fence about keeping or buying private health insurance.
Now, looking slightly ahead to July 2027, we really have to talk about negative gearing because the rules are fundamentally changing here. If you buy an established investment property after 2027, you can still deduct your losses, but only against your rental income. You cannot deduct it against your primary wages anymore. However, if you buy a new build or if you already own a property that you purchased before the budget announcement, those are completely grandfathered in under the old rules.
Similarly, capital gains tax is undergoing a pretty massive overhaul in 2027. The old 50% discount is being completely replaced by an inflation-based discount, and a new minimum 30% tax rate on capital gains is being introduced. Now, just like with negative gearing, this only applies to gains made after July 1st, 2027. Make no mistake, these are some of the biggest structural reforms to property tax we've seen in decades. So if you're an investor, you absolutely need to seek proper professional advice before these take full effect in 2027.
And finally, Section 5, Small Business Tax Boosts, Empowering the Entrepreneur.
So, the crucial point here is how you, as a business owner, practically apply these tools to free up your cash flow immediately. Step 1. The $20,000 instant asset write-off is now completely permanent. Buy a piece of equipment under $20,000 and you can deduct the whole shebang instantly. Step 2. The government has reintroduced the loss carryback scheme. This means if your business takes a hit and makes a loss this year, you don't have to wait around for future profitable years to use that loss. You can actually offset it against the taxes you already paid in the previous 2 years and get a cash refund right now. It's a real game changer.
And that brings us to the ultimate question for you. We've just walked through everything from your basic tax cuts and simple $1,000 deductions, all the way up to complex superannuation limits and massive property tax reforms. The rules of the game have totally been rewritten. So what does this all mean for you? Will you take 20 minutes this week to review your tax settings and adjust your strategy? Or will you ignore the shifts, keep missing those deductions, and just keep overpaying? The choice is entirely yours. Thanks so much for joining me for this explainer, and I'll see you next time.